This content is for informational and educational purposes only. It is not intended to be a substitute for professional financial, investment, legal, or tax advice. The creators of this content are not licensed financial advisors. Always seek the advice of a qualified professional with any questions you may have regarding your personal financial situation. Any action you take upon the information presented here is strictly at your own risk. The journey to financial wellness is unique to each individual, and the concepts discussed are general in nature. Hello and welcome. Over the next series of sessions, we're going to embark on a journey together. A journey to understand a concept that is often talked about, but frequently misunderstood: financial freedom. For many in the United States, this phrase conjures images of mega yachts, sprawling mansions, and a life of extravagant leisure. But what if I told you that for most people, the reality and the goal of financial freedom is something far more attainable, and frankly, far more meaningful? This series is designed to be a foundational guide, a starting point for your own exploration. We won't be telling you which specific stocks to buy or which real estate to invest in. Instead, our goal is to empower you with knowledge, to demystify the core principles, and to help you build a framework for thinking about your money and your life in a new way. So let's begin with the most fundamental question of all. What is financial freedom really? At its core, financial freedom is not about being rich. It's about having choices. It's the point at which you are no longer required to work for money to cover your basic and desired living expenses. Let me say that again, because it's the most important definition we will cover. Financial freedom is the state where your assets generate enough income to pay for your lifestyle, without you having to trade your time for a paycheck. Think of it like this. Right now, most of us are on a hamster wheel. We work to earn money. We use that money to pay for our life, our housing, food, transportation, and hopefully some fun. And then we have to go back to work to earn more. It's an active process. Financial freedom is about transitioning from this active income model to a passive or portfolio income model. It's about building systems, assets, that work for you, instead of you always working for them. This income from your assets can come from various sources. It could be dividends from a well-diversified stock portfolio. It could be rental income from real estate properties. It could be interest from bonds or high-yield savings accounts, or royalties from a creative work. The specific source is less important than the principle. The money flows in whether you actively clocked in for an 8-hour workday or not. Let's break down some of the most common myths surrounding this idea in the American context. Myth number 1. You need to be a multimillionaire to be financially free. This is perhaps the biggest misconception. Financial freedom is not a specific number in a bank account. It's a ratio. It is the ratio of your passive income to your expenses. Someone living a modest lifestyle in a low cost of living area might achieve financial freedom with a portfolio of $500,000. Meanwhile, someone with a high consumption lifestyle in an expensive city might need $5 million or more and still not feel free. The goal isn't just to accumulate a massive pile of cash. It's to create an income stream from your assets that consistently exceeds your spending. It's a very personal equation. Your number will be different from your neighbor's, and that is perfectly okay. Myth number 2. Financial freedom means you have to quit your job and never work again. For some, that might be the dream, and that's a valid goal. But for many, financial freedom isn't about escaping work. It's about having the power to choose the work you do based on passion and purpose, not necessity. It could mean leaving a stressful corporate job to become a teacher. It could mean starting your own nonprofit, writing a novel, or working part-time at a local coffee shop simply because you enjoy the community. The key word is choice. It removes the desperation from the career equation. You work because you want to, not because you have to in order to keep the lights on. This is a profound shift in mindset that can dramatically improve your quality of life long before you ever decide to stop working entirely. Myth number 3. It's all about extreme frugality and deprivation. You might have seen stories about people who save 80% of their income by eating nothing but rice and beans. While discipline and mindful spending are absolutely crucial components, and we will dedicate a whole chapter to this, the journey doesn't have to be one of misery. It's about aligning your spending with your true values. It's about cutting back ruthlessly on the things that don't bring you joy or value, so you can afford to spend on the things that do, all while saving and investing a significant portion of your income. It's about conscious spending, not just less spending. So why should you care? Why is this a goal worth pursuing? Because what you're really chasing isn't money. You are chasing what money can provide. You're chasing time. The time to be present with your family and watch your children grow up. The time to take care of your physical and mental health. the time to travel and see the world, or to simply sit on your porch with a good book on a Tuesday morning. You're also chasing security and peace of mind, the freedom from the gnawing anxiety that comes with living paycheck to paycheck. The knowledge that if a medical emergency happens, or if your car breaks down, or if you lose your job, you have a cushion. You have a system in place that protects you and your family. That kind of security is priceless. Finally, you're chasing autonomy, the ability to be the author of your own life story, to make decisions based on your own values and dreams, not on the demands of an employer or the fear of a looming bill. This is the new American dream. It's not about a white picket fence and 2 cars in the garage anymore. For a growing number of people, it's about owning your time and your life. As we close this first chapter, I want you to reflect on this reimagined definition. Forget the Lamborghinis and the private jets for a moment. Instead, ask yourself a simple question. What would I do with my days if I didn't have to worry about earning a paycheck? The answer to that question is the true prize. That is your why. And having a powerful why is the most important fuel you'll have on this journey. We've laid the groundwork today by defining what financial freedom is and, just as importantly, what it is not. We've established that it's a personal journey about creating choices, security, and autonomy. In our next chapter, we will take the very first practical step. Before you can map out a route to your destination, you need to know exactly where you are starting from. We will dive deep into understanding your current financial landscape, calculating your net worth, and tracking your cash flow. It's the essential diagnostic that makes everything else possible. Thank you for joining me. Take some time to think about your why, and I'll see you in the next chapter. Once again, a brief but important reminder. This content is for informational and educational purposes only and does not constitute financial, investment, legal, or tax advice. We are not licensed professionals. We strongly encourage you to consult with a qualified professional to discuss your individual circumstances before making any financial decisions. This chapter involves numbers and calculations, but these are for your personal understanding and awareness, not as a directive for any specific action. Welcome back. In our first chapter, we redefined financial freedom. We moved away from the fantasy of infinite riches and toward a more powerful and attainable goal: the freedom to choose your life's path, unburdened by financial necessity. We talked about your why, the deep, personal motivation that will fuel your journey. Now it's time to get practical. Imagine you're about to start a cross-country road trip. You have your destination in mind, your why, but you can't plot a course without knowing your exact starting location. In the world of personal finance, your starting location is your current financial reality. This chapter is all about finding that "you are here" pin on your financial map. We will do this by learning about 2 of the most critical concepts in personal finance: net worth and cash flow. It might sound intimidating, but I promise you, the concepts are simple. This step isn't about judgment. It's about awareness. Gaining clarity over your numbers is the first and most empowering step you can take towards changing them. Let's start with your net worth. Think of your net worth as a financial snapshot, a picture of your financial health at a single moment in time. The formula is incredibly simple. It's everything you own minus everything you owe. In financial terms, that's assets minus liabilities. First, let's look at assets. Assets are all the things you own that have monetary value. We can group them into a few categories to make it easier. Grab a piece of paper or open a new spreadsheet and start listing them out. 1. Cash and cash equivalents. This is the most straightforward. It includes the money in your checking account, your savings accounts, and any money market accounts. It's the liquid money you can access quickly. 2. Investments. This is a big one for many Americans. This category includes the current value of your retirement accounts, like a 401k or a 403b from your employer. It also includes personal retirement accounts like a Roth or traditional IRA. If you have a brokerage account where you own stocks, bonds, mutual funds, or ETFs, you'll list the current market value of those here as well. 3. Real estate. If you own a home, this is the current estimated market value of that property. You can get a rough idea from real estate websites or a more formal appraisal. Include any other properties you might own. 4. Personal property. This includes things like your car or other valuable possessions. A word of caution here: be realistic and conservative. Look up the current private party resale value of your vehicle, not what you paid for it or what you wish it was worth. Once you've listed all your assets, add them all up. This is the first half of your net worth equation. Now for the second half: liabilities. Liabilities are simply what you owe to others. It's your debt. The most common liabilities for people in the US include Your mortgage. The remaining balance on your home loan. Student loans. This is a significant liability for millions. List the total amount you still owe. Auto loans. The outstanding balance on your car loan. Credit card debt. The total balance across all your credit cards. Be honest here. This is one of the most important numbers to face. And finally, any other personal loans or medical debt you may have. Now add up all of your liabilities to get a total. You're ready for the final step. Take your total assets number and subtract your total liabilities number. The result is your net worth. Now, I want you to look at that number and take a deep breath. For many people, especially those early in their careers or those who have significant student loans, this number might be 0 or even negative. This is completely normal, and it is not a reflection of your worth as a person. It is not a grade. It is just a data point. It is your starting line. The goal is not to feel bad about it, but to know it. From this day forward, your goal will be to make that number go up over time. Knowing where you are is the only way to measure progress. So if net worth is the snapshot, our second concept, cash flow, is the movie. It tells the story of your money over a period of time, usually a month. The formula is just as simple. It's the money that comes in minus the money that goes out. Your income minus your expenses. Let's start with income. For most people, this is primarily their take-home pay from their job after taxes and other deductions. But also include any other income you might have from a side business, freelance work, or any rental income. Add it all up to get your total monthly income. Next up is expenses. This is where the real detective work begins. Many people know what they earn, but very few know exactly where it all goes. The best way to do this is to track your spending for a full month. You can use a simple notebook, a spreadsheet, or one of the many free budgeting apps available. The tool doesn't matter. The act of tracking does. Group your expenses into categories. First, fixed expenses. These are the costs that are roughly the same every month. Things like your rent or mortgage payment, your car payment, insurance premiums, and any subscription services. Second, variable expenses. These are the costs that change from month to month based on your usage and choices. This is your grocery bill, gasoline for your car, utilities like electricity and water, dining out, and entertainment. This category is often where people are most surprised. Third, what some people call sinking funds or irregular expenses. These are the costs that don't happen every month, but you know are coming. Think annual car registration, holiday gifts, or a yearly vacation. A common approach is to estimate the annual cost and divide by 12 to save that amount each month. Once you have tracked your income and your expenses for a month, you perform the simple calculation. Total monthly income minus total monthly expenses. The result is your monthly cash flow. If the number is positive, congratulations. That means you are living within your means and have money left over to save, invest, or pay down debt. This positive cash flow is the engine that drives your net worth up. If the number is negative, it means you are spending more than you earn, likely by taking on new debt. Again, do not panic. This is crucial information. You have now identified the core problem, and in the coming chapters, we will discuss strategies for how to fix it. Knowledge is power. To recap, you now have your two key metrics. Your net worth, which is your financial position today, and your cash flow, which is the direction you are heading each month. These two numbers are your financial GPS. They tell you where you are and where you're going. This can be a confronting exercise, but it is the most foundational step in taking control of your financial life. You cannot improve what you do not measure. Now that you know your starting point, we can begin to chart a course to your destination. In our next chapter, we will use this information to build a realistic and sustainable plan. We'll talk about how to create a budget that doesn't feel like a cage, and how to set clear, actionable financial goals that will guide your decisions. Thank you for your courage in taking this important step. I look forward to seeing you in Chapter 3. As always, we begin with our important reminder. The information provided in this chapter is for educational and informational purposes only. It is not financial, investment, or legal advice. The frameworks and methods discussed are general concepts to help you in your own research and planning. Your financial situation is unique, so please consult with a qualified financial professional to create a personalized plan that is right for you. Welcome back to our journey toward understanding financial freedom. In our first chapter, we discovered our destination by defining our personal why. In Chapter 2, we found our starting location on the map by calculating our net worth and analyzing our cash flow. Today we're going to draw the actual map. We're going to connect where you are to where you want to go. This chapter is all about building your roadmap through two powerful tools: budgeting and goal setting. Now, I know what many of you might be thinking when you hear the word budget. For a lot of people, it brings up feelings of restriction, deprivation, and sacrifice. It sounds like a crash diet for your wallet, focused on everything you can't have. I want to challenge you to completely reframe that idea. A well-crafted budget is not a cage, it's a tool of empowerment. It is not about restriction, it is about intention. Let's stop calling it a budget and start calling it a conscious spending plan. Its purpose is not just to track your money, but to ensure your money is working for you and aligned with your deepest values. The very same why we talked about in Chapter 1. A conscious spending plan doesn't just ask, how much did I spend? It asks, did this spending bring me closer to the life I want? So how do we do this? Instead of just cutting expenses randomly, we start by asking questions. For every dollar you spend, you can ask yourself, does this purchase align with my values? Is this moving me closer to one of my goals? For example, if your why is to have more time with your family, then spending money on a lavish car with a high monthly payment might not be in alignment. However, spending money on a service that frees up your weekends, like a meal kit delivery or a house cleaner, might be perfectly aligned. It's all about making conscious choices. To help structure this process, people often use established frameworks. These are not rigid rules, but helpful guidelines to get you started. Let's look at a few popular ones in the United States. Perhaps the most well-known is the 50/30/20 guideline. It's a simple starting point. The idea is to divide your after-tax income into 3 categories. 50% for your needs. These are the absolute must-haves: your housing, transportation to work, essential groceries, and utilities. 30% is allocated for your wants. This is the fun stuff: dining out, hobbies, entertainment, and travel. Finally, the remaining 20% is dedicated to savings and debt repayment. This portion is your wealth-building engine. It's the money you use to pay down high-interest debt, build your savings, and invest for the future. Again, this is a guideline. If you live in a high-cost-of-living city, your needs might be more than 50%. If you have significant high-interest debt, you may want to dedicate much more than 20% to that category. The power of this rule is its simplicity in showing you where your money is generally going. Another popular method is zero-based budgeting. The name sounds intense, but the concept is simple. At the end of the month, your income minus your expenses should equal 0. This doesn't mean you have no money left. It means every single dollar that came in has been assigned a job. Some dollars are assigned to the rent, some to groceries, some to entertainment, some to your 401k, and some to your savings account. You are proactively telling your money where to go, instead of retroactively wondering where it went. This method promotes a very high level of intention and financial awareness. Finally, there's the pay yourself first method. For many, this is the most sustainable approach. The principle is simple. Before you pay your rent, before you buy groceries, before you do anything else, you pay yourself. You decide on a specific amount or percentage of your income that you want to save and invest. Then you automate it. You set up an automatic transfer from your checking account to your savings or investment account that happens the day you get paid. You then live off of whatever is left. This simple trick leverages the power of automation and removes willpower from the equation. Your most important financial goals are taken care of before you even have a chance to spend the money. Finding the right system for you might take some experimentation, and that's okay. The goal is to find a method that you can stick with consistently. Now, a spending plan is the how, but it needs a destination. This is where goal setting comes in. A plan without a goal is just a list of numbers. To make your plan meaningful, you need to tie it to specific, motivating targets. A great framework for this is setting SMART goals. SMART is an acronym that stands for specific, measurable, achievable, relevant, and time-bound. Specific. Don't just say, I want to save more. Instead, say, I want to build a 3-month emergency fund. Measurable. Give your goal a number. My emergency fund needs to be $15,000. Achievable. Look at your cash flow from the last chapter. Is your goal realistic? If you only have $100 left over each month, aiming to save $15,000 in 1 year isn't achievable. You need to either adjust the goal's timeline or find ways to increase your income or decrease your expenses. Relevant. Does this goal matter to you? Does it align with your why? Saving for a goal you don't truly care about is a recipe for failure. And finally, time-bound. Give yourself a deadline. I will save $15,000 for my emergency fund in the next 24 months. This creates a sense of urgency and makes the goal real. It's helpful to categorize your goals into different time horizons. Short-term goals are things you want to accomplish in the next 1 to 2 years. The most important of these for everyone is building that emergency fund. We'll dedicate our entire next chapter to that. Other short-term goals might include paying off credit card debt. Mid-term goals are for the next 3 to 10 years. This could be saving for a down payment on a house, buying a new car with cash, or saving for your children's education. Long-term goals are for 10 years and beyond. For most of us, this is retirement and ultimately, achieving financial independence. Your conscious spending plan is the tool that turns these goals from dreams into reality. You look at your goals, break them down into monthly savings targets, and build those targets directly into your plan. So your task after this chapter is to think, what are your SMART goals? Write them down. Then, choose one of the spending plan frameworks we discussed, and see how you can adjust your cash flow to start making progress toward those goals. This is where the journey truly begins. You now have a destination, a starting point, and a map. In our next chapter, we will begin building the vehicle for our journey. We'll start with the most critical component of any financial plan, the financial safety net that protects you from life's unexpected turns. We're going to talk about building your emergency fund. Thank you for being here. I'll see you in the next chapter. As we dive into this critical topic, please remember our standard disclaimer. This content is for educational and informational purposes only. It is not a substitute for professional financial advice. The concepts discussed are general principles. We strongly advise you to consult with a qualified financial professional who can help you make decisions based on your unique personal circumstances. Welcome back. In our last chapter, we drew our financial roadmap by creating a value-based spending plan and setting powerful, SMART goals. We've defined our destination, we know our starting point, and we have a map to guide us. But before we start the engine and hit the road on this exciting journey, we need to do one more thing. We need to build our vehicle. And the foundation of that vehicle, the part that ensures it can handle the inevitable bumps in the road, is your emergency fund. Think of it this way. You would never build your dream house on a foundation of sand. You'd build it on solid concrete, strong enough to withstand storms and the test of time. An emergency fund is the concrete foundation for your entire financial life. It is, without a doubt, one of the most crucial steps towards achieving financial peace of mind and, eventually, financial freedom. It is the safety net that separates a minor inconvenience from a major financial catastrophe. So, what exactly is an emergency fund? At its core, it is a readily accessible pool of cash set aside for one purpose and one purpose only: to cover unexpected, urgent, and necessary expenses. It's just as important to understand what an emergency fund is for as what it is not for. An emergency fund is there to cover life's serious curveballs. This could be a sudden job loss, giving you breathing room to find a new position without panicking. It could be an unexpected medical or dental bill that isn't fully covered by insurance. It's for the furnace that breaks in the middle of a freezing winter, or the major car repair that's essential for you to get to work. What is it not for? It's not a vacation fund. It's not for holiday shopping. It's not a great deal on a new TV fund. Those are planned expenses. The beauty of a good financial plan is that you can and should save for those things separately, often in what are called sinking funds. An emergency fund is your break glass in case of emergency protection. It's purely defensive. Why is this so non-negotiable? Because having an emergency fund fundamentally changes your relationship with financial stress. First, it breaks the cycle of debt. For millions of Americans, an unexpected expense like a $500 car repair immediately goes on a high-interest credit card. This decision, born of necessity, digs them deeper into a financial hole that's hard to escape. With an emergency fund, that same $500 expense is no longer a crisis. It's an inconvenience. You pay for it with your saved cash, and then you work to replenish the fund. No debt, no interest, no stress. Second, it provides priceless peace of mind. The reduction in anxiety that comes from knowing you have a buffer between you and the unknown is life-changing. It helps you sleep better at night. And third, it protects your future. It stops you from derailing your long-term goals. Without an emergency fund, people are often forced to raid their retirement accounts, like their 401k, to cover a short-term need. This not only incurs taxes and penalties but also steals from your future self, often forcing you to sell investments at the worst possible time, like during a market downturn. Your emergency fund protects your investments so they can continue to grow for the long haul. So the big question is, how much do you need? While the exact number is personal, A general guideline often suggested by financial experts is to save between 3 to 6 months' worth of your essential living expenses. Let's be very clear about the word essential. This is not 3 to 6 times your monthly paycheck. This is the bare bones amount you would need to survive. Calculate it by adding up your must-pay bills. Your rent or mortgage, essential utilities, a basic grocery budget, transportation costs, insurance premiums, and any minimum debt payments. It does not include things like dining out, entertainment subscriptions, or vacation savings. This is your financial survival number. So should you save for 3 months or 6? This depends on your personal situation. 3 months might be appropriate for a household with 2 stable incomes in secure industries. 6 months or even more might be a better target for someone who is self-employed, works on commission, is the sole earner for their family, or has a less predictable income stream. Now, I know that for someone just starting out, a number like $15,000 or $20,000 can feel impossibly large. Don't let that discourage you. The first goal is not to have the full amount, but to simply start. Many people advocate for a starter emergency fund of around $1,000, or enough to cover 1 month's rent. The goal of this smaller fund is to get a buffer in place as quickly as possible. It will protect you from those smaller, more frequent emergencies, and give you the momentum to build toward your larger goal. Once you start saving, where should you keep this money? The location of your emergency fund has 3 very important criteria. 1. It must be liquid. This means you can access the cash quickly, typically within 1 or 2 days, without paying any penalties. 2. It must be safe. The principal amount should not be at risk. This means your emergency fund does not belong in the stock market or any other volatile investment. 3. It should be separate from your everyday checking account. This creates a psychological barrier. When the money is out of sight, out of mind, you'll be far less tempted to dip into it for non-emergencies. Given these criteria, a few common options emerge. A popular and effective choice is a high-yield savings account, or HYSA. These are typically offered by online banks. They are FDIC insured, meaning your money is safe up to the federal limit. They are completely liquid, and they are separate from your main bank account. As a bonus, they offer significantly higher interest rates than traditional savings accounts, allowing your money to at least partially keep up with inflation while it sits waiting. Other options include traditional savings accounts or money market accounts, which also meet the criteria of being safe and accessible. To recap, your emergency fund is your financial foundation. Start by calculating your essential monthly expenses. Set a smart goal to save 3 to 6 months worth of that number, and keep the money in a safe, liquid, and separate account. Your action step is clear. Calculate your number and start saving. Even if it's just $25 a paycheck, start. The habit and the momentum are what matter most. Now that we have a plan to build our foundation of safety, we can turn our attention to the other side of the equation. In our next chapter, we're going to get on the offensive. We will address the single biggest obstacle to building wealth for most Americans: high-interest debt. We'll explore practical strategies to tackle it and break free for good. Thank you for your commitment to this process. I'll see you in Chapter 5. Before we begin, a crucial reminder. This chapter discusses common strategies for debt repayment. This is for educational purposes only, and should not be considered personal financial advice. The choice of any debt repayment strategy has significant financial implications. We are not financial advisors. Please consult with a qualified, licensed professional to review your personal situation and determine the best course of action for you. Welcome back. Over the last 4 chapters, we have laid a powerful groundwork. We defined our destination of financial freedom, pinpointed our starting location with our net worth and cash flow, drew a roadmap with a budget and goals, and built our financial foundation with an emergency fund. Now, with our safety net in place, it's time to go on the offensive. It's time to confront the single biggest obstacle that holds most Americans back from building wealth: high-interest debt. Trying to save and invest while carrying a heavy burden of high-interest debt is like trying to walk up an escalator that's moving down. You're putting in the effort, you're taking steps forward, but the powerful force of compound interest is working against you, pulling you backward every single day. To make real progress, you have to turn off that downward escalator. First, it's helpful to understand a common framework people use to think about debt. Not all debt is viewed in the same light. Some financial commentators categorize debt into 2 general types. One is what's often called good debt.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This is typically debt used to purchase an asset that has the potential to grow in value or increase your earning capacity. Common examples include a sensible mortgage to buy a home, or reasonable student loans used to obtain a degree that leads to a higher-paying career. The other type is what's often referred to as bad debt. This is generally high-interest debt used for consumption, for things that are used up and gone. The most common examples in the US are credit card balances, high-interest personal loans, and payday loans. The interest rates on this type of debt can be incredibly high, often 15, 20, or even 25% or more. This is the debt that acts like a financial anchor, and this is what we'll focus on today. So, how do you begin to tackle it? It starts with a clear, strategic plan of attack. Step 1 is the most important. You have to stop digging the hole deeper. You cannot get out of debt if you are continuing to add to it. This means committing to not taking on any new high-interest debt. Your budget from Chapter 3 is your best tool here. You must find a way to live on less than you earn, so you are not relying on credit to fill the gaps. Step 2 is to know your enemy. You need to create a complete inventory of all your non-mortgage debts. Make a list. For each debt, write down 4 things: the name of the creditor, the total balance you owe, the minimum monthly payment, and most importantly, the interest rate, or APR. Having all of this information in one place gives you the clarity you need to make a plan. Step 3 is to find your weapon. In your budget, you need to identify an extra amount of money, above and beyond your minimum payments, that you can throw at your debt each month. This is your debt-fighting fund. Whether it's $50 or $500, this extra amount is what will accelerate your progress. Once you have your list and your extra payment amount, you need to decide on a method of attack. There are 2 very popular and effective strategies that people use. They are known as the debt snowball and the debt avalanche. It's important to understand how both work. Let's start with the debt snowball. This method focuses on psychology and motivation. Here's how it works. You continue to make the minimum payments on all of your debts. Then you take your entire debt-fighting fund and throw it at the debt with the smallest balance, regardless of its interest rate. You attack that one debt with everything you have. Once it's paid off, you experience a quick, powerful win. You've eliminated a creditor from your life. Then you take the full amount you were paying on that debt, its minimum payment plus your extra amount, and you snowball it onto the debt with the next smallest balance. As you pay off each debt, the snowball gets bigger and bigger, rolling faster and faster, until you've paid everything off. The main benefit here is behavioral. Those early wins can create incredible momentum and keep you motivated for the long journey ahead. The second strategy is the debt avalanche. This method focuses on pure mathematics. Here's how it works. You make the minimum payments on all your debts. Then you take your entire debt-fighting fund and throw it at the debt with the highest interest rate, regardless of its balance. You attack that most expensive debt first. Once it's paid off, you take the full payment amount and apply it to the debt with the next highest interest rate, and so on. The main benefit of the debt avalanche is that, mathematically, it will save you the most money in interest payments over time. Because you are eliminating the most expensive debt first, you are stopping that powerful force of compound interest from working against you as quickly as possible. This method will typically get you out of debt faster, and for less money than any other. The potential downside is that if your highest interest debt also has a very large balance, it might take a long time to pay it off, and some people may find that discouraging. So which method is better? There is no single right answer. The best method is the one that you will actually stick with. Some people are motivated by the math and want the most efficient path. They might prefer the avalanche. Other people know they need those quick wins to stay in the game. They might prefer the snowball. Both are excellent frameworks that have helped millions of people become debt-free. The goal is to choose one, commit to it, and be consistent. To recap, becoming debt-free requires a strategic approach. Stop adding new debt, list out everything you owe, and choose a systematic plan like the snowball or avalanche to pay it off with focused intensity. Your action item for this chapter is to create that debt inventory. List your debts, balances, and interest rates. Then, look at the 2 methods we discussed and think about which approach aligns better with your personality. Getting out of debt is one of the most liberating financial steps you can take. It frees up your most powerful wealth-building tool, your income. And that leads us directly to our next topic. Once the anchor of high-interest debt is gone, what do you do with that freed-up income? In our next chapter, we will introduce the exciting world of investing for the long term, demystifying core concepts and explaining how you can finally start making your money work for you. Thank you for your focus and dedication. I'll see you in Chapter 6. This chapter contains an educational overview of general investment concepts. It is critically important to understand that this is not investment advice. We are not financial advisors, brokers, or licensed professionals. The information provided is for educational purposes only. All investing involves risk, including the possible loss of principal. Before making any investment decisions, you should speak with a qualified and licensed financial professional who can assess your personal situation, risk tolerance, and goals. Welcome back. In our last chapter, we created a battle plan to attack and eliminate high-interest debt, freeing up our most powerful wealth-building tool, our income. For the past several chapters, we've been focused on building a strong financial defense and clearing away obstacles. Now the moment has arrived to shift our mindset from defense to offense. It's time to learn how to put your money to work for you. It's time to talk about investing. The concept of investing is the engine of financial freedom. Remember our core definition from Chapter 1? Financial freedom is the point where your assets generate enough income to cover your expenses. Investing is the process of acquiring those assets. So what is investing? At its simplest, investing is the act of using your money to buy something, an asset, with the expectation that it will generate income or be worth more in the future. It's a fundamental shift from only trading your time for money to having your money start to make more money all by itself. It's crucial to distinguish investing from saving. Saving is putting money in a safe place, like an emergency fund, for short-term goals. The primary goal of saving is to protect your money. Investing, on the other hand, involves taking on a calculated level of risk with the goal of achieving significant growth over the long term. Many people are fearful of investing because they equate it with gambling. This is a common misconception. Gambling is typically a short-term, high-risk bet on an uncertain outcome. Long-term investing is about ownership. It's about owning a small piece of the productive capacity of the US and world economies, which over long periods of time, have historically grown. The reason investing is so powerful comes down to one magical concept: compound growth. We've talked about how compound interest works against you with debt. With investing, it becomes your single greatest ally. Compounding is the process where your investment returns start earning their own returns. It creates a snowball effect. A small amount of money, given enough time, can grow into a very large amount of money. This is why the most important factor in a successful investing journey is not timing the market, but time in the market. The earlier you start, the more time your money has to compound and grow. To begin understanding investing, it's helpful to know about the basic building blocks, often called asset classes. Let's touch on two of the most fundamental ones. First, we have stocks. A stock, also called an equity, represents a small share of ownership in a publicly traded company. When you buy a share of a company's stock, you become a part owner of that business. There are generally two ways you can make money from a stock. One, if the company does well and grows, the value of your ownership share, the stock price, can increase. This is called appreciation. Two, some companies share a portion of their profits directly with their shareholders. This is called a dividend. Historically, stocks have offered the highest potential for long-term growth, but they also come with higher volatility, meaning their prices can go up and down significantly in the short term. Second, we have bonds. A bond is essentially a loan. When you buy a bond, you are lending money to a government or a corporation. In exchange for your loan, the issuer promises to pay you periodic interest over a set term, and then return your original investment, the principal, at the end of that term. Generally speaking, bonds are considered to be less risky than stocks and provide more stable, predictable income. Because of this lower risk, their potential for high growth is also typically lower than stocks. Now, if you were to buy a stock in just one single company, that would be very risky. If that one company performs poorly, your entire investment is at risk. This brings us to what is perhaps the single most important principle for new investors: diversification. You have almost certainly heard the phrase, "Don't put all your eggs in one basket." That is the essence of diversification. It means spreading your investments across many different assets, so that the poor performance of any single one doesn't have a disastrous impact on your overall portfolio. But for an individual, buying dozens or hundreds of different stocks and bonds would be expensive and complicated. So, how do most people achieve diversification? They often do it through investment vehicles like mutual funds and index funds. A mutual fund is a professionally managed portfolio that pools money from thousands of investors to buy a wide variety of stocks, bonds, or other assets. When you buy a share of a mutual fund, you are instantly diversified across all of the fund's holdings. An index fund is a specific, passive type of mutual fund. Instead of having a manager actively picking and choosing investments, an index fund simply aims to own all the investments in a particular market index and mirror its performance. For example, the S&P 500 is an index that represents 500 of the largest companies in the United States. An S&P 500 index fund's goal is to hold all of those 500 companies. By buying just one share of such a fund, an investor can achieve broad diversification across a huge swath of the American economy. This is a very common and low-cost way that many people build their long-term investment portfolios. To recap, investing is the long-term process of owning assets to allow your money to grow. Compound growth is the force that makes it so powerful. The basic building blocks include stocks and bonds, and diversification is the key principle to help manage risk. This has been a very high-level introduction. The world of investing is vast, and our goal today was simply to demystify the core ideas and make it feel more accessible. Now that we understand the what and why of investing, you may be wondering where you actually do it. In our next chapter, we'll explore the common types of investment accounts available in the US, such as the 401k, the IRA, and a standard brokerage account. We'll explain the purpose of each and discuss why they are often referred to as wrappers for your investments. Thank you for joining me on this crucial step. I'll see you in Chapter 7. We must begin with our most important disclaimer. The following discussion of investment accounts involves concepts related to tax law in the United States. This is for general informational and educational purposes only, and is not financial, investment, or tax advice. Tax laws are complex and subject to change. We are not tax professionals or financial advisors. Please consult with a qualified and licensed professional, such as a certified public accountant or a financial advisor, to understand which accounts and strategies may be appropriate for your specific situation. Welcome back. In our last chapter, we demystified the world of investing. We learned that it's about owning assets like stocks and bonds, and we discovered that the magic of compound growth is the engine that can power our journey to financial freedom. We understood the what and the why. Today, we're going to talk about the where. Where do you actually hold these investments? The answer is inside an investment account. This is a point of confusion for many beginners, so let's clarify it with an analogy. Think of an investment, like an S&P 500 index fund, as your food. Think of the investment account as the plate you put it on. The food is separate from the plate. The plate is just a container that holds the food. Similarly, an investment account is simply a container or a wrapper that holds your investments. What makes these plates different from one another are the rules and, most importantly, the tax treatments that apply to them. The United States government, through the tax code, has created different types of accounts to encourage citizens to save for important goals, especially retirement. Understanding these accounts is key to building an effective, long-term investment strategy. Let's explore 3 of the most common types of investment accounts in the U.S. First up is the one many of you may already have. An employer-sponsored retirement plan, like a 401k, or a similar plan like a 403b for nonprofit employees. This is a retirement savings account that you get through your job. One of the most powerful features of a traditional 401k is that contributions are often made pre-tax. This means the money is taken out of your paycheck before federal and state income taxes are calculated. As a result, it can lower your taxable income for the year, which is a nice immediate benefit. Inside the account, your investments grow tax-deferred, meaning you don't pay taxes on the dividends or capital gains each year. The taxes are paid later, when you withdraw the money in retirement. But perhaps the most attractive feature of many 401k plans is the employer match. This is where your company contributes money to your account on your behalf. A common example is a company matching 100% of your contributions up to, say, 5% of your salary. This is often described by financial commentators as the closest thing to free money you can get. It's a 100% return on your investment, instantly. Next, let's talk about individual retirement arrangements, or IRAs. As the name suggests, these are retirement accounts that you open on your own, separate from any employer. There are 2 main types. First is the traditional IRA. It works in a way that is similar to a traditional 401k. Depending on your income and whether you have a retirement plan at work, your contributions may be tax-deductible. Your investments grow tax-deferred, and you pay ordinary income tax on the money when you withdraw it in retirement. The second type is the Roth IRA. The Roth IRA works in the reverse. You contribute money that you have already paid taxes on. Your contributions are after tax, so there is no upfront tax deduction. But here is the incredibly powerful benefit. Your investments grow completely tax-free, and when you take qualified withdrawals in retirement, that money is also completely tax-free. This can be a huge advantage, especially if you expect to be in a higher tax bracket in the future. Both types of IRAs have annual contribution limits set by the government. Finally, we have the standard taxable brokerage account. Think of this as a general-purpose investment account. It doesn't have any of the special tax advantages of a 401k or an IRA. You fund it with after-tax money. As your investments generate dividends or you sell them for a profit, you will generally owe taxes on those gains in the year they are realized. This is often referred to as capital gains tax. While it doesn't have the tax benefits, the taxable brokerage account offers the most flexibility. There are no limits on how much you can contribute each year, and there are no restrictions on when you can withdraw the money. This makes it a suitable container for midterm financial goals, like saving for a house down payment, or for additional investing after you have taken full advantage of your retirement accounts. To summarize, think of these accounts as tools for different jobs. The 401k is a great tool for retirement savings, especially when there's an employer match. IRAs, both traditional and Roth, are powerful personal tools for retirement, offering different tax treatments. A taxable brokerage account is a flexible tool for goals outside of retirement, or for when you've maxed out your other options. Your action item for this chapter is to do some research. If you have a job, find out if you have a 401k and if there is an employer match. Then you can begin to explore the IRA options available through various financial institutions. Now that we understand the core concepts of investing and the accounts used to hold those investments, it's time to put it all together. How do you prioritize? Where should your first investment dollar go? In our next chapter, we will discuss a common framework often called the financial order of operations, a step-by-step priority list to help guide your financial decisions. Thank you for being here. I'll see you in Chapter 8. As we begin, it is essential to state our disclaimer. The following chapter outlines a logical framework for prioritizing financial decisions. This is a generalized educational model, not personalized financial advice. Every individual situation is unique, and the right order of operations for you may differ. We strongly recommend consulting with a qualified financial professional who can help you create a plan tailored to your specific circumstances and goals. Welcome back. Over the course of this series, we have armed ourselves with a tremendous amount of knowledge. We've learned how to budget, how to build an emergency fund, how to attack debt, and we've demystified the concepts of investing and the accounts that hold those investments. With all this information, a new, very practical question often arises. Okay, I know what I need to do, but what do I do first? It can feel overwhelming to try and do everything at once. This is where a clear, prioritized plan becomes your most valuable tool. Today, we're going to tie everything together by discussing a concept often called the financial order of operations. Just like in mathematics, where you follow a specific order, like PEMDAS, to solve a complex equation correctly, a financial order of operations provides a logical sequence for your money. It's a framework designed to help you use your income in the most effective way possible, ensuring you are building a strong foundation and taking advantage of the most powerful opportunities first. Let's walk through a common version of this framework, step by step. Step 1. Contribute enough to your 401k to get the full employer match. If you have a 401k at work with an employer match, this is almost always the first priority. Why? Because an employer match is the highest guaranteed return on your money you will ever find. If your company offers a 100% match on the first 5% of your salary that you contribute, you are earning a 100% return on your investment instantly. There is no other investment that can promise that. Not taking advantage of this is like turning down a pay raise. The first dollars you invest for your future should go here, up to the full match amount. Step 2. Pay down high-interest debt. Once you've secured your full employer match, the next step for many is to aggressively pay down high-interest debt, like credit cards or personal loans. As we discussed in Chapter 5, this debt is like a financial anchor. Paying off a credit card with a 22% interest rate is mathematically equivalent to getting a guaranteed, risk-free 22% return on your money. No investment can reliably promise that kind of return. By eliminating this debt, you stop the powerful force of compound interest from working against you and free up your income for wealth building. Step 3. Build a fully funded emergency fund. In Chapter 4, We talked about starting an emergency fund. Now, with the free money from the match secured and the financial fires of high-interest debt extinguished, it's time to build that fund up to its full strength. The goal is to have 3 to 6 months of essential living expenses saved in a safe, liquid account. This robust safety net is what allows you to invest with confidence. It ensures that a job loss or a medical emergency won't force you to sell your long-term investments at the worst possible time. Step 4. Max out tax-advantaged retirement accounts. With a full emergency fund in place, you are now in a powerful position to accelerate your long-term savings. The focus shifts to taking full advantage of the tax-advantaged retirement accounts we discussed in Chapter 7. A common approach to this step is as follows. First, contribute to an IRA, either a Roth or a traditional, up to the annual limit. IRAs often provide a wider range of investment choices and potentially lower fees than many 401k plans. After you have maxed out your IRA contributions for the year, the next move is to go back to your 401k and increase your contributions beyond the employer match, with the goal of reaching the annual IRS limit if your budget allows. Step 5. Invest for other goals in a taxable brokerage account. What happens when you've done all of the above? You've gotten your match, you're debt-free, you have a full emergency fund, and you are maxing out your retirement accounts. This is a fantastic financial position. Any additional money you have to invest can now go into a taxable brokerage account. This account offers maximum flexibility for midterm goals, like saving for a house down payment in 5 to 10 years, or simply for building additional long-term wealth beyond your retirement accounts. This order of operations brings clarity to a complex process. It turns a long list of should-dos into a focused, one-step-at-a-time mission. Your action item for this chapter is to evaluate where you currently stand in this framework. What is your very next logical step? Focus your energy and your extra income on that one step. So far, our series has focused on how to accumulate and grow your wealth. But building wealth is only half the battle. You also have to protect it. In our next chapter, we will shift our focus to risk management. We'll discuss the vital role of insurance, like health, disability, and life insurance, in safeguarding your financial well-being and protecting your journey to financial freedom. Thank you for your continued dedication. I'll see you in Chapter 9. Before we proceed, a critical disclaimer is necessary. This chapter provides a general educational overview of insurance concepts. It is not intended to be, and should not be taken as financial, legal, or insurance advice. We are not licensed insurance professionals. Insurance is a complex field, and your individual needs are unique. It is essential to consult with a qualified, licensed insurance agent or professional who can help you assess your personal situation and find appropriate coverage. Welcome back. For the majority of this series, our focus has been on offense. We've been learning the strategies to build our savings, pay off debt, and grow our wealth through investing. But a successful financial plan has both a powerful offense and an unbreakable defense. Building wealth without protecting it is like building a beautiful home in a storm-prone area and neglecting to install storm shutters. All of your hard work and progress could be wiped out by a single, unpredictable event. Today, we're building our defense. We're installing the financial storm shutters. We are going to talk about the essential role of insurance. The fundamental purpose of insurance is simple. It's a tool for risk transfer. You pay a small, predictable fee, called a premium, to an insurance company. In exchange, that company agrees to take on a large, unpredictable, and potentially catastrophic financial risk for you. The core principle is to insure against risks that you cannot afford to cover yourself. You don't need insurance to replace a broken toaster, but you absolutely need it to protect against events that could lead to financial ruin. Let's walk through the foundational types of insurance that form the defensive line for a solid financial plan in the United States. First, and most importantly, health insurance. In the U.S. financial system, health insurance is the absolute, non-negotiable bedrock of your financial safety. The cost of medical care is so high that a single major accident or illness can easily result in bills totaling hundreds of thousands of dollars, leading to bankruptcy for even the most diligent savers. Health insurance is the shield that stands between you and these potentially devastating costs. Understanding key terms like your deductible, which is what you pay before insurance kicks in, and your copays or coinsurance, which is your share of the cost, is vital to using your plan effectively. Second, disability insurance. This is often one of the most overlooked but most critical forms of insurance. Think of it as paycheck insurance. For most of us, especially in our working years, our single greatest asset is not our home or our car. It's our ability to earn an income. What would happen to your financial plan if an illness or injury prevented you from working for a year, 5 years, or even longer? A long-term disability can be more financially destructive than almost any other event. Disability insurance is designed to replace a portion of your income if you become disabled and are unable to work, ensuring that you can still pay your bills and maintain your standard of living. Many employers offer this as a benefit, and it's crucial to understand the coverage you may have. Third, life insurance. The purpose of life insurance is often misunderstood. It is not for you. It is for the people who financially depend on you. The core question to ask is, if I were to pass away unexpectedly, would someone I care about suffer financially? If you have a spouse who relies on your income, young children, or anyone else who depends on you, life insurance is a vital tool. It is designed to replace your income for them, allowing them to pay the mortgage, cover daily living expenses, and fund future goals. When exploring life insurance, you will generally encounter two main categories. The first is term life insurance. This is often described as pure insurance protection. You buy a policy that covers a specific period, or term, such as 20 or 30 years. If you pass away during that term, your designated beneficiary receives the death benefit. It is typically the most affordable way to get the largest amount of coverage. The second category is permanent life insurance, of which whole life is a common type. These policies are designed to provide coverage for your entire life. They also include a savings or investment component known as cash value. These policies are significantly more complex and come with much higher premiums than term insurance. They can serve different financial planning purposes, and it's important to understand the distinctions. Fourth, property and casualty insurance. This category includes your auto insurance and your homeowners or renters insurance. These policies do two main things. First, they protect the value of your assets, your car and your home. But second, and arguably more importantly, they provide liability coverage. Liability protection is what covers you if you are found at fault for an accident that injures another person or damages their property. In a serious car accident, for example, a lawsuit could potentially target all of your assets and savings. The liability portion of your insurance policy is what stands in the way, protecting the net worth you've worked so hard to build. To summarize, insurance is not an investment meant to make you rich. It's a vital expense designed to prevent you from becoming poor. It's the defensive strategy that allows your offensive, wealth-building strategy to succeed over the long run. Your action item for this chapter is to conduct a personal risk review. Look at your own life and ask, what are my biggest financial vulnerabilities? Review any insurance policies you currently have to understand what you're covered for. To get a professional assessment, consider speaking with a licensed, independent insurance agent who can help you analyze your needs without being tied to a single company's products. We have now covered how to build your wealth and how to protect it. A truly comprehensive plan also considers what happens to that wealth at the end of your life. In our next chapter, we will introduce the basics of estate planning, covering fundamental concepts like wills and trusts in a clear, educational way. Thank you for taking this important step in securing your financial future. I'll see you in Chapter 10. This chapter provides a general educational overview of estate planning concepts. This is one of the most critical disclaimers in our series. This content is not legal or tax advice. Estate planning laws are complex, vary significantly from state to state, and are subject to change. We are not attorneys or tax professionals. Attempting to handle these matters without professional guidance can have serious, unintended consequences. You must consult with a qualified estate planning attorney in your state to receive advice and create legal documents tailored to your specific situation. Welcome back. Throughout this series, we have journeyed through the process of building a financial life with intention. We've learned how to build our wealth on offense and how to protect it on defense with tools like insurance. Today, we're going to discuss the final piece of a truly comprehensive plan. What happens to the assets you've built after you're gone? This is the world of estate planning. For many, the topic feels morbid or is dismissed as something only for the very wealthy.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
But in reality, estate planning is not about death, and it's not about riches. It's a profound act of care and responsibility for the people you love. A good estate plan is your final gift to your family, designed to minimize confusion, conflict, and cost for them during an already difficult time. At its core, estate planning is the process of creating a clear set of instructions for managing your assets during your lifetime and distributing them after you pass away. If you don't create a plan, your state's government has one for you. This is called dying intestate, and the state's rules may not align at all with your wishes. Having a plan ensures that you, not the courts, get to decide. Let's go over some of the fundamental components of an estate plan. Our goal here is simply to understand the concepts, not to implement them. First is the last will and testament, commonly known as a will. A will is a legal document that states your final wishes. It does several key things. It names an executor, who is the person or institution you trust to carry out your instructions. It specifies which assets go to which people or charities. And for parents of young children, it serves a critically important function. It allows you to name a legal guardian for them. This alone is reason enough for any parent to have a will. Typically, a will must go through a court-supervised process called probate, where a judge validates the will and oversees the distribution of assets. This process can be public, time-consuming, and costly. Next is a concept you've likely heard of, a trust. A trust is a legal arrangement. You, the creator of the trust, transfer assets into it. You then name a trustee to manage those assets for the benefit of your beneficiaries. One of the most common types is a revocable living trust. A key feature of using such a trust is that the assets held within it can often pass to your beneficiaries outside of the probate process. This can make the transfer of assets much faster, less expensive, and because it's not a public court record, more private than a will alone. Trusts are more complex to set up than wills, but can offer more control and flexibility. A third and very powerful component of your plan is your beneficiary designations. For accounts like your 401k, IRAs, and life insurance policies, you fill out a form naming a beneficiary, the person who will receive the account's assets upon your death. It is absolutely critical to understand that these beneficiary designations are a direct contract with the financial institution, and they typically override what's written in your will. If your will says your entire estate goes to your spouse, but your IRA beneficiary is a parent from a previous relationship, the IRA will go to your parent. Keeping these designations reviewed and up to date is a simple but vital part of estate planning. Finally, a complete estate plan isn't just about what happens after you die. It also protects you if you become incapacitated and unable to make decisions for yourself. There are two key documents for this. A durable power of attorney is a legal document where you appoint someone to make financial decisions on your behalf if you cannot. This allows your trusted person to pay bills and manage your investments, preventing a legal mess. A healthcare directive, sometimes called a living will or healthcare proxy, allows you to appoint someone to make medical decisions for you and to state your wishes regarding end-of-life care. To summarize, an estate plan is your instruction manual for the future. It ensures your assets go to the right people, provides for your loved ones, and can make a difficult process much smoother for your family. The basic tools include a will, potentially a trust, up-to-date beneficiary designations, and directives for incapacity. Your action item for this chapter is very different from previous ones. It is not to download a form from the internet or try to do this yourself. Your action item is to simply recognize the profound importance of this process. When you are ready, the correct and only next step is to seek out a qualified estate planning attorney in your state of residence. They are the only professionals who can give you proper legal advice to build a plan that truly reflects your wishes and complies with the law. We have now covered the full life cycle of a financial plan, from your first budget to your final legacy. In our next chapters, we will begin to explore some of the deeper, often invisible, forces at play, starting with the fascinating field of behavioral finance and the psychology of money. Thank you for engaging with this important topic. I'll see you in Chapter 11. As we explore the fascinating topic of financial psychology, please remember our standard disclaimer. This chapter is for educational and informational purposes only, designed to promote self-awareness about common behavioral patterns. It is not financial advice, nor is it a substitute for professional psychological or therapeutic advice. The concepts discussed are general in nature and may not apply to your individual circumstances. Welcome back. For the last 10 chapters, we have been meticulously building a machine. We've learned about the parts, budgets, savings, debt, investments, insurance, and estate plans. We've learned how to assemble them in the right order. We've focused on the numbers, the strategies, and the logic. But a machine, no matter how well designed, is only as good as its operator. And that operator is you. Today, we're going to shift our focus from the spreadsheets to the person staring at them. We are diving into the world of behavioral finance, the psychology of money. You see, achieving financial success is often less about what you know and more about how you behave. The greatest risks to your financial plan are often not in the stock market, but in the mirror. Think of your brain as having two competing systems. Nobel Prize-winning psychologist Daniel Kahneman popularized this idea. There's System 1, which is fast, intuitive, and emotional. It's your gut reaction. Then there's System 2, which is slow, analytical, and deliberate. It's your rational mind. The entire challenge of long-term financial success is making sure your slow, logical System 2 is making the decisions, especially when you're fast, emotional System 1 is panicking or getting greedy. Let's explore a few of the most common psychological biases that can hijack our logical brains and sabotage our financial progress. First, and perhaps most powerful, is loss aversion. Studies have shown that the pain of losing $1 is roughly twice as powerful as the pleasure of gaining $1. We are wired to avoid loss at all costs. How does this play out in investing? When the stock market has a correction, which is a normal and healthy occurrence, the emotional brain screams, "We're losing money. Sell everything and make the pain stop." This feeling can be overwhelming, causing investors to sell their holdings at low prices out of fear, locking in their losses. Then, when the market recovers, they are left on the sidelines. The key to overcoming loss aversion is to have a solid plan in place before the storm hits, and to remind yourself that volatility is the price of admission for long-term growth. Second is herd mentality. Humans are social creatures. We have a deep-seated instinct to follow the crowd. We assume that if everyone is doing something, it must be the right thing to do. In the financial world, this is a recipe for disaster. Herd mentality is what creates speculative bubbles. A certain stock or asset becomes the talk of the town. You see it on the news, your friends are talking about it, and you feel a powerful fear of missing out, or FOMO. So you pile in along with the herd, often buying at the peak. Then when sentiment shifts, the herd panics and stampedes for the exit, and you sell at the bottom. The legendary investor Warren Buffett famously advised the opposite. Be fearful when others are greedy, and greedy when others are fearful. Sticking to your own well-thought-out, diversified plan is the antidote to herd mentality. Third, we have confirmation bias. This is our brain's tendency to seek out and favor information that confirms what we already believe, and to ignore information that contradicts it. Let's say you think a certain company is a fantastic investment. Confirmation bias will lead you to only click on the positive news articles about that company. You'll watch the glowing YouTube reviews and dismiss any critical analysis as noise. This creates an echo chamber in your mind, making you feel overly certain about your decision and blind to potential risks. To fight this, you must actively play devil's advocate with your own ideas. Purposefully seek out the opposing viewpoint. Ask yourself, what is the argument against this investment? Fourth is overconfidence and recency bias. Recency bias is our tendency to take recent events and project them indefinitely into the future. When this is combined with overconfidence, it can be particularly dangerous. After a long bull market where stocks have only gone up for years, it's easy to start feeling like an investing genius. You forget that risk is real. You might start taking on more risk than you're comfortable with, abandoning diversification because one part of your portfolio is doing exceptionally well. You start to believe that the recent good times are the new normal. But markets move in cycles. The best way to guard against this is humility and a deep respect for history. Remember that past performance does not guarantee future results, and stick to the timeless principles of a balanced, diversified portfolio. Understanding these biases is like having a superpower. When you feel that jolt of fear during a market downturn, you can pause and say, that's just loss aversion talking. When you feel the urge to buy a speculative asset, you can ask, is this a sound decision, or is it herd mentality? Your action item for this chapter is one of self-reflection. The next time you feel a strong emotion about money, fear, greed, excitement, or panic, take a moment. Pause. Ask yourself, is this my logical, long-term brain making this decision? Or is my emotional, short-term brain trying to take control? Simply being aware of these forces is the first and most important step to mastering them. We've now looked inward at our own psychology. In our next chapter, we will look outward at the broader environment we operate in. We will provide a simple overview of key economic concepts like inflation, interest rates, and recessions, and understand how they can affect our personal financial journey. Thank you for being here. I'll see you in Chapter 12. Before we begin, a standard but important disclaimer. This chapter provides a simplified, high-level overview of complex economic topics for educational purposes only. It is not intended as economic forecasting or financial advice. Economic conditions are unpredictable. The goal of this chapter is to help you understand the concepts, not to advise you on how to react to them. Always consult with a qualified financial professional for advice tailored to your situation. Welcome back. In our last chapter, we looked inward, exploring the fascinating and powerful role our own psychology plays in our financial journey. We learned that mastering our own behavior is paramount. Today, we're going to look outward. We're going to zoom out from our personal finances and take a look at the broader economic landscape that we all operate in. You do not need to be an economist to achieve financial freedom, but understanding the basic weather patterns of the economy can be incredibly empowering. When you hear terms like inflation, interest rates, and recession in the news, it can be scary and confusing. Our goal today is to demystify these concepts so you can understand them, remain calm, and stick to the solid financial plan you've been building. Let's start with a term we all experience every day: inflation. In the simplest terms, inflation is the rate at which the overall price of goods and services in an economy is rising. As prices rise, the purchasing power of your money goes down. A dollar today simply doesn't buy as much as it did a year ago. If a loaf of bread that cost $3 last year costs $3.15 this year, that 5% increase in price is a rough measure of inflation. Why does this matter so much to your financial plan? First, inflation is a silent force that erodes the value of your savings. If you have a large amount of cash sitting in a checking account that earns 0 interest, and inflation is running at 3%, your money is effectively losing 3% of its real value every single year. This is the single most important reason why money for long-term goals, like retirement, must be invested. The goal of investing is to generate a rate of return that significantly outpaces the rate of inflation over time. Second, inflation directly impacts your budget. When the cost of essentials like groceries, gasoline, and housing goes up, you feel it immediately. Your monthly expenses can increase even if you haven't changed your lifestyle, which means your conscious spending plan needs to be a living document that can adapt. Next, let's talk about interest rates. An interest rate is quite simply the cost of borrowing money. When you take out a loan, the interest rate is the price you pay for using someone else's money. When you save money, it's the rate the bank pays you for using your money. In the United States, the Federal Reserve, or the Fed, plays a key role in influencing interest rates. When you hear news about the Fed raising rates, it means they are taking action to make borrowing more expensive across the entire economy. This has a direct impact on you. When interest rates go up, the cost of new mortgages, car loans, and credit card debt also goes up. On the flip side, you might earn more interest on your cash in a high-yield savings account. When interest rates go down, borrowing becomes cheaper, which can make it a better time to take out a loan for a home or a car. The interest you earn on your savings, however, will also likely go down. Interest rates are a primary tool the Federal Reserve uses to manage the economy, often raising them to combat high inflation. Finally, let's discuss the word that often causes the most fear: recession. A recession is a significant and prolonged downturn in economic activity. Businesses may produce less, and consumer spending may fall. The most direct and personal impact of a recession is on the job market. As businesses cut back, there is a higher risk of layoffs and unemployment. It is absolutely crucial to understand that recessions are a normal, natural, and unavoidable part of the economic cycle. Economies have always and will always go through periods of expansion and contraction. They are not a sign that the system is broken. They are a feature of how the system works. How does a well-built financial plan hold up? First, this is why the emergency fund we discussed in Chapter 4 is so vital. A full 3 to 6 month emergency fund is your #1 defense against job loss during a recession, giving you the time and resources to navigate a tough job market without going into debt. Second, the stock market often declines during a recession. This is where the psychological resilience we talked about in Chapter 11 is tested. An investor with a long-term perspective understands that these downturns are temporary and avoids the fatal mistake of panic selling at the bottom. In fact, many long-term investors view market downturns as opportunities to continue investing according to their plan, purchasing assets at lower prices. You cannot control inflation. You cannot control interest rates. And you cannot control when the next recession will occur. But you can control your own financial house. You can control your savings rate, your spending, your debt levels, and your investment strategy. A strong financial plan with a robust emergency fund, low or no high-interest debt, and a diversified, long-term investment portfolio is designed to be resilient and to weather any economic storm. Your action item today is simply to become a more informed observer. The next time you hear these economic terms in the news, you'll have a better framework for what they mean, allowing you to filter out the noise and focus on what you can control. Now that we understand the broader economic context, we can zoom back in on some major practical decisions. In our next chapter, we'll tackle one of the biggest financial goals for many Americans: preparing for homeownership. Thank you for joining me. I'll see you in Chapter 13. Before we discuss this significant topic, we must start with our disclaimer. This chapter provides a general educational overview of the financial considerations of buying a home in the U.S. It is not real estate, financial, legal, or tax advice. The decision to buy a home is deeply personal and complex, with long-term financial implications. We strongly urge you to consult with qualified professionals, including a financial advisor, a reputable lender, and a real estate attorney, before making any decisions. Welcome back. In our last chapter, we zoomed out to look at the broad economic landscape. Today, we're going to zoom back in on one of the most significant and personal financial decisions that is directly influenced by that landscape: buying a home. For generations, homeownership has been considered a cornerstone of the American dream and a primary vehicle for building wealth. But it's also the largest financial commitment most people will ever make. Our goal today is not to tell you whether you should or shouldn't buy a house. Instead, our goal is to arm you with a clear understanding of the financial groundwork required, so you can make an informed and confident decision for yourself when the time is right. First, let's talk about financial readiness. Before you even start looking at listings online, it's important to assess if your financial house is in order. This assessment should look familiar, as it's built on the foundations we've already discussed in this series. A good checklist for financial readiness includes a stable and reliable income. Lenders will want to see a consistent history of employment. A fully funded emergency fund. Your 3 to 6 month emergency fund is more crucial than ever when you own a home. Roofs leak and water heaters break at the most inconvenient times. Your emergency fund is the barrier between a repair bill and a credit card bill. Low debt. Lenders will look closely at your debt-to-income ratio, or DTI. This is a percentage that compares your total monthly debt payments to your gross monthly income. A lower DTI indicates you have more financial breathing room. And finally, a strong credit score. Your credit score is a major factor in determining the interest rate on your mortgage. A higher score can translate into a lower interest rate, which can save you tens of thousands of dollars over the life of the loan. Once you are financially ready, the next step is to understand the significant upfront costs. There are two main components. The first is the down payment. This is the portion of the home's purchase price that you pay upfront in cash. You have likely heard the common benchmark of a 20% down payment. The primary reason for this benchmark is to avoid something called private mortgage insurance, or PMI. PMI is an extra monthly fee that is often required if you put down less than 20%. It's important to understand that PMI is insurance that protects the lender, not you, in case you default on the loan. While there are loan programs such as FHA loans that allow for much lower down payments, they often have their own mortgage insurance requirements. The second upfront cost is closing costs. These are the various fees required to finalize the real estate transaction. They are completely separate from your down payment. Closing costs can include things like lender application fees, the home appraisal fee, title insurance, and attorney fees. As a general guideline, you can expect closing costs to be anywhere from 2% to 5% of the home's purchase price. This can be a significant amount of cash you need to have ready on closing day. Beyond the initial purchase, it's vital to understand the true, ongoing costs of homeownership. The monthly payment is often more than just the mortgage itself. A simple way to remember the main components is the acronym PITI. P stands for principal. This is the part of your payment that actually reduces your loan balance. I stands for interest. This is the cost you pay to the lender for borrowing the money. T stands for taxes. These are the property taxes you pay to your local government, which are often collected monthly by your lender and held in an escrow account. And the final I stands for insurance. This is your homeowner's insurance premium, which is also typically paid via your escrow account. But the costs don't stop at PITI. The biggest financial surprise for many new homeowners is the cost of maintenance and repairs. When you're a renter, the landlord is responsible when something breaks. When you're the owner, that responsibility is all yours. A common financial rule of thumb is to budget at least 1% of your home's value each year for these ongoing costs. For a $400,000 home, That's $4,000 a year, or over $300 a month set aside just for maintenance. The rent versus buy debate is a false choice. Renting is not throwing money away. You are paying for a service, a place to live with flexibility and no responsibility for maintenance. Buying a home is a way to build equity over the long term, but it comes with significant costs, a lack of flexibility, and a great deal of responsibility. The right choice is a personal and financial one, and it's different for everyone. Your action item is to use these concepts as a guide for your own research. If homeownership is a goal, begin by honestly assessing your financial readiness. Use online mortgage calculators to explore what different home prices would realistically cost each month in your area, including estimates for taxes and insurance. This is a phase of information gathering, not decision making. We've now covered some of the biggest financial goals and decisions in life. But throughout this entire journey, there's one constant expense we can't avoid: taxes. In our next chapter, we'll provide a high-level, educational introduction to the U.S. tax system, exploring the basic concepts and general strategies for improving tax efficiency on your path to financial freedom. Thank you for being here. I'll see you in Chapter 14. We must begin with our most direct and serious disclaimer of the series. The following content provides a general, high-level overview of concepts related to the United States tax system for educational purposes only. It is not tax advice. The U.S. tax code is incredibly complex and changes frequently. We are not certified public accountants, CPAs, enrolled agents, EAs, or tax attorneys. You must consult with a qualified, licensed tax professional for advice regarding your individual tax situation. Welcome back. Throughout our journey together, we've focused on how to earn, save, and invest your money. Today we're going to talk about how to keep more of it. For most Americans, taxes are their single largest expense over their lifetime, often exceeding what they spend on housing or food. Therefore, understanding the basic principles of how taxes work is not a boring chore. It's a critical strategy for accelerating your path to financial freedom. First, let's establish a crucial philosophical point. We are going to discuss tax efficiency, which is sometimes called tax avoidance. This is very different from tax evasion. Tax evasion is illegal. It involves hiding income or lying to the government, and it carries severe penalties. Tax efficiency, on the other hand, is the legal and ethical process of arranging your financial affairs to minimize your tax liability, using the rules and incentives that the government has created. The tax code is designed to encourage certain behaviors, like saving for retirement, and understanding these incentives is key. Let's demystify some core concepts of the U.S. tax system. First up are tax brackets and tax rates. The U.S. has a progressive tax system. This doesn't mean your entire income is taxed at a single high rate. It means your income is divided into different levels, or brackets, and each bracket is taxed at a progressively higher rate. This leads to two important terms. Your marginal tax rate is the rate you pay on your very next dollar of income. It's the rate of your highest tax bracket. This is the number that is most useful for making financial decisions. Your effective tax rate, on the other hand, is the actual blended percentage of your total income that you pay in taxes. Your effective tax rate will always be lower than your marginal tax rate, which is a key point many people misunderstand. Next, let's clarify the difference between tax deductions and tax credits. A tax deduction reduces your taxable income. Think of it like shrinking the size of the pie that the government is allowed to tax. For example, a contribution to a traditional 401k is a common tax deduction. A tax credit, however, is even more powerful. A tax credit reduces your final tax bill, dollar for dollar. Think of it as a gift certificate that you hand to the IRS. A $1,000 tax credit reduces your tax bill by the full $1,000. Now let's tie this back to investing. One of the most effective ways to be tax efficient is to use the right account wrappers that we discussed in Chapter 7. You can think of your investment accounts as falling into three main tax buckets. Bucket number 1 is tax deferred. This includes accounts like a traditional 401k or a traditional IRA. The simple way to remember this is pay taxes later. You often get a tax deduction on your contribution today, your money grows year after year without being taxed, and you finally pay income tax on the money when you withdraw it in retirement. Bucket number 2 is tax-exempt, or tax-free. This includes accounts like a Roth 401k or a Roth IRA. The mantra here is pay taxes now. You contribute with money you've already paid taxes on, so there's no upfront deduction. But in exchange, your money grows completely tax-free, and all your qualified withdrawals in retirement are also completely tax-free. Bucket number 3 is the taxable bucket. This is your standard brokerage account. You fund it with after-tax money, and you pay taxes along the way. When your investments pay dividends, that's typically taxed in the year you receive them. When you sell an investment for a profit, you pay capital gains tax. This brings up a key concept for taxable accounts: the difference between long-term and short-term capital gains. A short-term gain comes from selling an asset you've held for 1 year or less. It's typically taxed at your higher, ordinary income tax rate. A long-term gain from an asset held for more than 1 year is typically taxed at a much more favorable, lower rate. This is a clear incentive built into the tax code to encourage long-term, patient investing over short-term speculation. To summarize, your goal is not to avoid taxes illegally, but to intelligently use the rules of the system. This means understanding the basic concepts, maximizing your use of tax-advantaged retirement accounts like 401k, and IRAs, and investing with a long-term mindset. Your action item for this chapter is to respect the complexity of this topic. Start by keeping good financial records. And most importantly, when it comes to filing your taxes or making major financial decisions, strongly consider hiring a qualified tax professional, like a CPA or an enrolled agent. The value they provide in ensuring compliance and identifying legal tax-saving strategies can often far exceed their cost. We have now covered how to build, protect, and optimize your financial plan. We've explored the mechanics and the mindset. In our final chapter, we will bring it all together, focusing not just on the goal of financial freedom, but on the true purpose behind it: living a rich life, both now and in the future. Thank you for your attention to this vital topic. I'll see you in our final chapter. Welcome back for our final chapter. Before we conclude, a final and comprehensive disclaimer for the entire series. The content provided across these 15 chapters has been for informational and educational purposes only. It is not, and was never intended to be, a substitute for professional financial, investment, legal, tax, or health advice. We are not licensed professionals. The journey to financial well-being is unique to each individual. We strongly urge you to consult with qualified, licensed professionals who can provide advice tailored to your specific life and circumstances. Thank you for your understanding and diligence. We began this journey together with a single fundamental question: what is financial freedom, really? Over the course of our series, we have systematically assembled a complete blueprint to answer that question, not just in theory, but in practice. We started by finding our why. We learned how to take a fearless snapshot of our financial lives. We drew a roadmap with a conscious spending plan and set powerful, meaningful goals. We built our foundation with an emergency fund and went on the offensive against debt. We demystified the world of investing, exploring the accounts and the strategies to put our money to work. We built our defense with insurance and planned our legacy. We navigated our own psychology, the broader economy, and life's biggest financial decisions. We have covered the mechanics, the tools, and the strategies. But for this final chapter, I want to bring our focus back to where it all began: the why. Because the greatest risk in this entire endeavor is to master the how, but forget the purpose. The danger is to reach a financial destination, only to realize you left the best parts of your life behind on the journey. Let's start by redefining the word rich. Our culture often defines it with images of extravagant consumption, but a truly rich life has very little to do with the price tag of your possessions. A rich life is defined by having options. It's the freedom to choose how you spend your days. It is autonomy over your time, security for your family, and the ability to pursue work, hobbies, and relationships that fill you with a sense of purpose. Money is simply the tool. A rich life is the project. Never confuse the tool with the project. There is a psychological trap that many ambitious people fall into called the arrival fallacy. It's the belief that, I will finally be happy when I'm debt-free, when my net worth hits $1 million, when I can finally quit my job. But the truth that countless people who have reached these milestones discover is that the happiness from arrival is often fleeting. Financial freedom is not a light switch that you flip one day in the distant future. It is a dimmer switch that you gradually, intentionally, turn up over the course of your life. Every dollar of high-interest debt you pay off doesn't just change a number on a spreadsheet. It buys you a little more peace of mind today. Every dollar you automatically invest isn't just for your future self. It's a declaration of hope and an act of self-care now. Every time you make a conscious spending decision that aligns with your true values, you are not depriving yourself. You are actively crafting a richer life in this moment. The true purpose of this journey is not to suffer for decades in order to finally live. It is to use the principles of financial freedom to live better, starting immediately. As we close, I want to leave you with 5 pillars that I believe support a truly rich life, both now and in the future. Pillar 1: Consciousness. Know where your money is going. Be intentional. Align your spending with what truly matters to you. Pillar 2: Resilience. Build a financial foundation that can withstand the storms of life. Your emergency fund and your insurance are the bedrock that allows you to take calculated risks and sleep peacefully at night. Pillar 3: Patience. Understand that this is a marathon, not a sprint. True, sustainable wealth is built slowly, brick by brick, through decades of consistent, disciplined effort. Trust the process of compound growth, and ignore the siren song of get-rich-quick schemes. Pillar 4: Generosity. A life focused only on accumulation can feel empty. One of the greatest joys that financial stability provides is the ability to be generous with others. Generosity is a muscle. The more you use it, the stronger it gets, and the more fulfilling your own life becomes. Pillar 5: Gratitude. Be grateful for where you are today. Celebrate your progress, no matter how small. Acknowledge how far you've come. Gratitude is the antidote to the endless pursuit of more, and the foundation of true contentment. You now have the map. You understand the principles. The journey from here is yours to walk. It will require discipline, patience, and at times sacrifice. But it is not a journey of deprivation. It is a journey of intention, empowerment, and purpose. Thank you for allowing me to be your guide on this path. The goal was never just to have more money. It was and always will be to have more life. Go live it.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.